Hey everyone, and welcome to this explainer. I am so incredibly glad you're joining us today because we're going to unpack something truly fascinating. We're going to take a journey starting from the absolute widest macro view of the global economy and zoom right down into the micromechanics of this massive, hidden engine that is literally running in the background of our financial system. It's this whole world of financial intermediation that largely operates completely outside the traditional rules you might be familiar with. If you want to understand how money actually moves around the planet today, and more importantly, where the hidden pressure points are, you are in exactly the right place. Because ultimately, these hidden gears, they dictate the stability of the very markets your retirement and savings rely on.
So, let me start by asking you a direct question. When we talk about the global financial system, who actually holds the money? Take a second. Think about it. If you're like most of us, your mind probably goes straight to the big, towering banks, right? You think of those household names, the institutions where we deposit our paychecks, get our mortgages, secure business loans. It's totally natural to assume that traditional banks are the biggest players in town, basically steering the ship of global finance. But what if I told you that assumption is actually completely outdated?
Okay, prepare yourself for a little bit of scale shock here. $503.7 trillion. That jaw-dropping, almost incomprehensible number is the total value of global financial assets at the end of 2024, according to the Financial Stability Board's Global Monitoring Report. I mean, this is the absolute widest lens we can use to look at human wealth and financial activity. It's an insane amount of capital just sloshing around the globe. And here is exactly where our traditional assumptions get totally upside down.
Now, what's really interesting about this slide is the breakdown of that massive pie. The non-bank financial intermediation sector, or NBFI for short, holds the clear majority share at 51%. Meanwhile, traditional banks only hold 38%. Central banks and public financial institutions make up the rest. So the non-banks have literally eclipsed the traditional banks. We're talking about insurance corporations, pension funds, and this massive category called other financial intermediaries, which includes your investment funds and money market funds. Guys, they are the new titans of the global financial system.
And listen, this sector isn't just big, it is accelerating. In 2024, the NBFI sector grew by 9.4%. That is expanding at exactly double the pace of the traditional banking sector, which only grew by 4.7%. So why is this happening? Well, the data points to a highly buoyant global risk appetite. We saw easing financial conditions, lower policy rates in major advanced economies, and increasing asset prices. All of these factors essentially acted like rocket fuel, driving incredible investor inflows straight into these non-bank entities.
But when we actually look under the hood, the nature of this explosive growth reveals a really fascinating dichotomy. Take equity funds, for example. Their growth was spectacular, sure, but over 85% of it was driven simply by asset valuations. Basically, the stock market went up, so their assets under management went up. It was growth driven by market vibes and performance. Now, compare that to fixed income funds. Their growth was fundamentally different. Over 85% of their expansion was driven by actual hard cash inflows from investors seeking yield. This difference is absolutely vital because it shows us exactly how different types of capital are behaving in this current environment. Let's move to and see how this builds, because we really need to follow the money down the funnel and filter this down to what matters for systemic stability. We started with the total $503.7 trillion. Inside that is the $256.8 trillion NBFI sector. Inside that are the other financial intermediaries at $169.4 trillion. And right at the bottom of this funnel, we find a very specific, highly monitored subset worth $76.3 trillion. Authorities call this the narrow measure. And folks, this is the layer where the flashing red lights of financial stability are located.
So what exactly is the narrow measure? Think of it as the regulatory danger zone. It's a $76.3 trillion subset of non-bank entities that act an awful lot like banks. They provide credit, they lend money, but they do it in ways that pose bank-like financial stability risks. They engage in maturity and liquidity transformation, and they often rely heavily on short-term wholesale funding. The really critical issue here is something called run risk, because they aren't traditional banks, right? So they don't have the same robust government safety nets or deposit insurance to catch them if they fall. If investors suddenly panic and demand their money back all at once, these entities can face a devastating run.
So the crucial point is how this $76.3 trillion is actually distributed. Regulators break it down into economic functions, or EFs. Just look at EF1. These are your collective investment vehicles like money market funds and fixed income funds, entities that are highly susceptible to runs. And notice their share,
76.1%. The vast majority of the risk in the narrow measure is concentrated right here, in funds that offer daily liquidity to investors while holding assets that might be much harder to sell in a crisis. The other functions, like finance companies, broker-dealers, and securitization vehicles, they just make up much smaller pieces of the pie.
But here is the number that really jumps off the page in the 2024 data: 15.1%. That was the growth rate of EF1 last year. Not only is it the largest chunk of the risk layer, but it was also the only economic function in the narrow measure to experience double-digit growth. The pool of money most susceptible to a sudden panic in a bank-run dynamic is expanding rapidly. And obviously, this significantly raises the stakes for systemic stability, because as this pool grows, so does the potential shockwave if things ever go south.
Okay, let's dive into this, because data on a screen is one thing, but how does this actually play out in the real world? Well, we don't have to guess, because in early August of 2024, the global financial system went through a very real stress test. It was a sudden, intense bout of market volatility that perfectly illustrated the exact vulnerabilities regulators have been warning us about.
Here is the exact sequence of how quickly things unraveled. First, market expectations shifted regarding the interest rate differential between the US and Japan, and the yen began to appreciate. Second, this triggered a massive, sudden unwinding of yen-funded carry trades, basically investors rushing for the exits all at once. Third, this forced a sharp, brutal, though thankfully short-lived, fall in the Japanese stock market. And fourth, this localized shock instantly radiated outward, causing massive intraday spikes in global equity volatility indices. It was just a rapid, brutal chain reaction.
The Financial Stability Board actually analyzed this exact event and concluded, the episode showed that markets remain susceptible to bouts of volatility and illustrated the potential for leverage and liquidity mismatches to interact with one another and amplify the impact on the system. That word right there, amplify, is exactly why we are talking about this today. The underlying structural faults in the non-bank sector, their use of leverage, the mismatch between the liquidity they promise investors and the actual liquidity of the assets they hold, these act as massive amplifiers whenever the market experiences a shock.
And this brilliantly illustrates a rather terrifying reality. The hidden half of finance isn't isolated. You might think, well, if a hedge fund or a money market fund fails, that's their problem, not my bank's. Nope, not true. There are three main forms of interconnectedness. First, non-banks place massive deposits directly into traditional banks. Second, banks lend heavily to non-banks, often through really complex repo agreements. And third, massive investment in pension funds holds securities issued by the banks themselves. They are intrinsically deeply tied together. A risk event in the non-bank sector will immediately and unavoidably bleed straight into the traditional banking sector.
Now, as if the highly connected $76.3 trillion narrow measure wasn't enough to keep regulators up at night, the 2025 Global Monitoring Report pivoted to highlight a final, highly unsettling reality. It's something they refer to as the private credit blind spot. This is an area of finance that is booming right now, but the people in charge of monitoring systemic risk frankly admit they are struggling to see it clearly, which is exactly what you want to hear from the people monitoring global financial stability, right?
So why exactly is private credit so hidden? First, there is literally no standard definition of private credit activities across international statistical and regulatory reports. That means the watchdogs can't even agree on what they're looking at. Second, because of this lack of definition, authorities across the 29 monitored jurisdictions find it incredibly difficult to consistently identify who the private credit entities even are. Like, is it a trust company, a structured finance vehicle, an insurance corporation? And third, and this is the real kicker, guys, most of these private credit entities are excluded from that narrow measure we just spent time on. Why? Because they don't usually offer daily liquidity, meaning they don't face traditional run risk. But just because they can't suffer a classic bank run doesn't mean they don't pose entirely new, poorly understood risks to the whole system.
Which brings us to the ultimate question we have to ask ourselves today. We know the non-bank sector is vast, $256.8 trillion. We know it holds the majority of global wealth. We know it's expanding at double the pace of traditional banks. And we know it is built on an incredibly complex web of interconnectedness, amplified by leverage and obscured by massive regulatory blind spots in booming areas like private credit. So, if this is the foundation of modern capital, just how resilient is the hidden half of the global financial system? Honestly, it's a question the data suggests we should all be asking. Because when the next big shock arrives, it probably won't be coming from the bank on the corner. It'll be coming from the shadows. Thank you so much for joining me on this deep dive, and as always, keep your eyes on the data.